Hi, everyone. Good morning, good afternoon, and good evening. Welcome to GRASFI paper session 11, Green ESG and Asset Pricing. This is Jing. Hi, everyone. Welcome to GRASFI paper session 11, Green ESG and Asset Pricing. This is Jing Li from Tsinghua University. It's my great pleasure to help moderate this session. And we have 3 papers in this session. And for each paper, there will be 20 to 20 minutes for the presentation. And after that, will be a 5 minutes Q&A. So let's start with the first paper. It's brought by Ms. Weiming Zhang. So Weiming, Elaine, it's your turn.
Do I need to turn on my video? I think so. Hi, everyone. This is Elaine from the Chinese University here, from the Chinese University of Hong Kong. First of all, thank you so much for having me here, and I'm pretty honored to kick off this session. Today, I'm going to present this paper, ESG Preference, Institutional Trading, and the Stock Return Patterns, co-authored with Jiecao, Sheridan, Titman, and Xintong, Zhan. Since this is a conference about sustainability, so I guess you guys are very familiar with the concept of ESG investing, but still let me start with some background information. SRI, socially responsible investing, is a type of investment style that considers not only the financial returns, but also the social impact of the firm within that portfolio. It's sometimes also called ESG investing. There are 3 big categories under ESG investing: environmental, social justice, and corporate governance. Recent years have seen a huge development of ESG investing. At the end of 2016, out of every $5 under professional management in the US, more than 1 goes to ESG investing. In total, there are 8.7 trillion aggregate assets are held by the more than 477 institutional investors and the 300 money managers. So from 1995 to 2016, SRI universe has increased nearly 14-fold. To cater for the increasing demand of ESG investing, in April 2016, Morningstar introduced a fund-level ESG rating called Morningstar Sustainability. Well, it's called Morningstar Sustainability. This is a screenshot from Morningstar website, and it's the information for Vanguard Large Value Fund. So on this corner, we can see this fund has a pretty low sustainability rating, which means this fund holds a lot of stocks with very bad ESG performance. With the number and the graph, we can see there's an increasing interest on the ESG investing. So it's essential to study the following question: how the trend of socially responsible investing will affect the trading behavior of investors, and are there any implications of stock returns? Well, if you are a socially responsible institution nowadays, your primary goal still is making the money, right? But in addition to that, you now need to consider the social performance in addition to the traditional mispricing signal. So when the mispricing signal arrives, socially responsible institutions will underreact to it because they have another consideration, i.e. ESG performance. As a result, for stocks more held by socially responsible institutions, the process of mispricing, the correction of mispricing will be slower. However, the mispricing will eventually adjust to its fair value. So those kind of stocks, we are going to see a stronger return prediction power. And empirically, we find the consistent results here. This is a preview of our finding. Socially responsible institutions indeed trade less towards mispricing signals compared to other institutions. And the return predictability of mispricing signal is much stronger among firms held by more socially responsible institutions because they underreact to the mispricing signal. While it is a new phenomenon emerged with the recent growth of ESG investing, we did the same test for the early period and the recent period. The pattern only shows up in the recent period. And we find the results mainly come from the period when funding capital for upcharger activity is tight. Last but not least, if the stocks held by more socially responsible institutions have stronger return prediction power, then those kind of stock actually is associated with lower stock price efficiency. Okay, let's have a look at the data. Our data is quite standard. We got ESG score from MSCI ESG stat, formerly known as KLD database. And we utilize two mispricing signals here. One is Danbao and Yuan monthly mispricing score, which combines 11 anomalies into a single measure. A second one is standardized unexpected earnings signal, which is called SUE. And after doing a common filters, there are 2,103 stocks per month, and these stocks are pretty large, with the institution ownership of 71% and followed by around 10 analysts. So next, I'm going to talk about the main measures in our paper, socially responsible institution ownership. There are 3 steps to calculate this measure, and I'm going to go through them one by one. First of all, we are going to infer the type of institutions by looking at what kind of stocks they are holding. So we calculate an institution's social responsible score. Each quarter for each institution, we calculate the score using the weighted average of size-adjusted ESG score of the stocks in that institution portfolio. And secondly, for all the institutions, after we calculate the score, we rank them into 3 groups based on the score. And those fall into top tercile are defined as socially responsible institutions. And the third step, we are going to calculate this SRIO measure on the stock level using 2 ways. One is the number of shares held by socially responsible institutions divided by the total number of shares held by all the institutions. And secondly, is the number of socially responsible institutions holding that particular stock divided by the total number of institutions holding that stock. Well, another important measure in this paper is mispricing signal, and we use 2 measures, two mispricing signals here. One is Danbao Yu and Yuan mispricing signal. They use 11 stock anomalies documented in the literature, and every month stocks are sorted into 100 groups based on each anomaly. After that, each stock is assigned with the group rank. Then we take the average of this 11 anomaly rank of these 11 anomalies. The score will range from 1 to 100 theoretically. So 100 means most overpriced stocks, and 1 means most underpriced stocks. To do an easy interpretation, we use the opposite sign of this score. So based on this, the opposite sign of this score, we form stocks into 5 groups based on the stock. P5 means most underpriced stocks, and P1 means most overpriced stocks. As a second mispricing signal we utilize is called standardized unexpected earnings signal, SUE, which is calculated using the current quarter's earning minus the average earning of prior 4 quarters, scaled by the standard deviation of unexpected earnings over the last 8 quarters. So in the literature, they find a higher SUE is associated with a higher stock return in the future. After I introduce the main measures in our paper, we're going to look at some empirical tests here. The first question we are going to examine is, do socially responsible institutions underreact to mispricing signals? So here we are looking at their trading behaviors. First of all, we sort all the stocks into 5 groups based on SYY score, and the P5 are most underpriced stocks, while P1 are most overpriced stocks. This table reports the change in institution ownership for both socially responsible institutions and other institutions. We can see socially responsible institutions do not trade according to the mispricing signal, while other institutions indeed increasing the holding for the underpriced stocks and decrease the holding for the overpriced stocks. The difference between the trading behavior of these two types of institutions are statistically significant. So this is the first evidence showing that socially responsible institutions indeed react less to mispricing signals. Well, in addition to looking at the change in institution ownership, we also look at the change in the number of institutions holding that stock, and the results are even stronger. Alternatively, if we use SUE as the mispricing signal instead of SYY, we find exactly same pattern here. So the next question is, how do SRIs affect stock return patterns? We conjecture that when there are sufficient SRIs holding a particular stock, the underreaction of SRI is large enough, so the mispricing, the correction of mispricing is very slow, but the price will eventually adjust to its fair value. So we are going to see a return predictability in the future. And to test this impossibility, here we do a double independent sort based on the mispricing signal and SRIO. If we look at the first row, we can see the mispricing signal still works, which generate a 0 basis point per month in terms of pharma French 3-factor alpha. And this spread mainly comes from the stocks held by more socially responsible institutions, because when the mispricing signal arrives, socially responsible institutions do not react very quickly, so mispricing could not be corrected immediately, and leading to a very negative return in the future for overpriced stocks. The results are consistent if we look at the SUE as a second proxy for the mispricing signal. So if the pattern we documented here is indeed because of the rising of ESG investing, then naturally you would expect the results should not be so significant in the early period when ESG investing is not so popular. To test that, we carry out an exact same test for the early period from 1996 to 2003. And here is the results. We can see back then, the prediction power of mispricing score is actually even stronger, but there's no much difference among stocks held by more socially responsible institutions and fewer socially responsible institutions. The pattern only emerged in the recent period when ESG investing becomes mainstream of the society. So up to now, I've been talking a lot about socially responsible institution investors, socially responsible investors, but there are other market participants here, for example, the arbitrageurs. The question is, why don't those arbitrageurs take the money away from the table? Our proposed answer is because they do not have enough money. So before we look at the empirical results, let me ask you, who are those arbitrageurs in your mind? Basically, normally you will answer they are hedge funds, right? But according to a survey by Barclay, actually hedge funds, nowadays hedge funds care about their ESG, also care about their ESG increasingly, especially for those large hedge funds. So here, arbitrageurs are actually those small hedge funds who do not care about ESG at all, but they are most constrained by the funding conditions. So to test that hypothesis, we divide the whole sample period into two parts, two subperiods based on the capital constraint shocks. And if we look at the results here, the results only show up during the low funding liquidity period, when there's less arbitrage capital and those arbitrageurs cannot correct the mispricing. So we see a return pattern shows up here. In addition to document the return pattern here, we further look at the stock price efficiency. The intuition goes like this way. If a stock held by more socially responsible institutions, we have a stronger return prediction power of mispricing score, then it means that mispricing, the correction of mispricing is slower. So the stock price efficiency should be lower among those kind of stocks. And to test that hypothesis, we imply this price delay proxy proposed by Ho and Moskowitz in their 2005 paper. A higher price delay measure means a lower stock price efficiency. And we do a panel regression here. We find consistent results. For example, if we look at the early period, we do not find any relationship between SRI and the price delay. But if we look at the recent period, high SRIO is actually associated with a higher price delay or lower stock price efficiency. And the significance only comes from the low funding liquidity period when the arbitrageurs do not have enough money to correct the mispricing. Beyond that, we also did a bunch of robustness tests. For example, you may ask, are the firms with high SRIO and low SRIO different in other firm characteristics, especially limits to arbitrage? The answer is no. On the contrary, we actually find high SRIO stocks tend to be more larger, more liquid, and are covered by more financial analysts, while the return prediction power exists among those kind of stocks. So it means our results are not caused by the limits to arbitrage or other firm characteristics. And also, are the return results robust to different risk models? Yes, we find the results are consistent if we look at the Pharma French 4-factor alpha and the kappa M. And in addition to using KLD database, we also employ SF4 as an alternative ESG measure, and we find consistent results. Finally, we rule out the alternative that our results might drive by the passive investing or drive by the investment horizon of the institutions. Okay, let me conclude here. We find that the preference for social performance can affect investment decision and stock return patterns. And the social responsible institutions react less to mispricing signals because they have other factors to consider. While the emergence of socially responsible institutions has a very important impact on the efficiency of mispricing signals and the stronger return predictability of mispricing signal in stocks with high socially responsible institution ownership. In addition, we find that results mainly come from the later period when ESG becomes more popular and from periods when funding capital for arbitrage activity is tight. Finally, we document that the presence of socially responsible institutions actually lower the stock price efficiency. Well, basically, that's all about my presentation. Thanks for listening. And if you have any questions, feel free to ask.
Thanks, Leung. A very good time control. And thanks for the presentation. And it's very impressive to learn that social responsible institutions, they tend to underreact to the earning disclosure. Sounds like they are more tolerant. And at the same time, I see there is one question from the audience. In case if not everyone could see it, I will repeat it. So the first question is, may the reason for the underreaction by social responsible investors be that they are longer-term investors and do therefore not immediately react to earnings? May not immediately react to earnings surprises, but look more at longer-term expectations of earnings.
Thanks so much for the question. Yes, we think it's possible. So to rule out that possibility, here we actually control the investment horizon. Specifically, we calculate a churn ratio of the institution and we aggregate to the stock level. Then we first sort stocks on the investment horizon, then double sort on our socially responsible institution ownership and mispricing level. In that sense, we control for this investment horizon and still find the strong results, which means our results are beyond the investment horizon.
Yeah, good to learn that. So I guess I think that for that question, also we have the second question. To what extent may the slower speed of price responses to the information also be explained by the increasing popularity of the passive funds?
Thank you for your question again. Well, that's another possibility, and because we know passive funds also becomes more and more popular recently. So to rule out that possibility here, we actually do another robustness check. Instead of constructing socially responsible institution ownership, we only focus on the active mutual fund ownership and calculate a mimicking mutual fund, socially mutual fund ownership measure, and we do the test using that measure. We find consistent results. Yeah, thank you.
So probably due to the limited time, Elaine did not show too much details regarding the robustness check. The one regarding the long-term and the other is the passive and the active funds here. So we still have some time here waiting for the audience question. And also I have a quick question when we are waiting for the audience question. Like in your paper, you mentioned there's 3 steps in construct that ratio,
Yes.
the social responsible institutional ownership. And actually you mentioned that in the 3rd step, the defined definition is according to some certain cutoff for all the institutions. And they also mentioned that it will be into 3 groups. So I'm just curious, what the cutoff here, just simply like the 33%, something like that, or some special cutoff here?
Here we just do like 33.33%, because on average, like we have 5,000 to 6,000 institutions each quarter. So around 2,000 institutions will be classified as socially responsible institutions. It's a relatively comparison. In addition to that, we also cut off using the cutoff of 50% and also use the 4 groups to cut off, and our results still hold using different kind of cutoffs.
I see. Good to learn that. So still some time. Any other questions here? Okay, I see there are no more questions from the audience. So thank you for Elaine, very good time control. So we have some time ahead here. Okay, so let's move to the second paper. It's brought by Aaron Young from Northwestern University. The paper title is Stock Price Reactions to ESG News, the Role of ESG Ratings and Disagreement. Aaron, it's your turn now.
So Jing, I'm getting a message. Oh, okay, never mind. Sorry, you guys can see my face, right? Great. So thank you everyone for listening in, and I also thank the conference organizers for giving this paper an opportunity to be featured at GRASFI. This paper is titled Stock Price Reactions to ESG News, the Role of ESG Ratings and Disagreement. And it's joint work with George Serafeim at HBS. So motivation of starting this paper is super simple. Just like most of the papers here in this conference, ESG has been a really sort of growing phenomenon in the recent years, right? So for example, in 2019 summer, Business Roundtable 200, that represents roughly 200 top companies in the US's CEO, those folks came out and redefined the role of companies from shareholder focus to stakeholder focus, and sort of called for incorporating ESG into their company operations. From an investor's perspective, there's this initiative called the UNPRI, United Nations Principles for Responsible Investment. And the below chart is an illustration of how fast that their AUM grew in the past 15 years. When it started off right around 2005, 2006, the AUM, the total AUM of UNPRI signatories globally was roughly 200 to 300 billion US dollars, if I recall correctly. This number grew to 120 trillion US dollars by 2020. So to give you some context of how much 120 trillion US dollar is, that's roughly about 3 times the entire market cap of United States stock market. So there's it's no joke that everyone's cousin is interested in investing or claims to engage in ESG issues. But here comes the issue with ESG ratings and using ESG rating as a newer set of performance evaluation. There are recent papers such as Berg et al., Christensen et al., pointing out that ESG ratings have very low correlation. So different ESG vendors' rating are not that highly correlated, most likely because, ESG is multidimensional, difficult to agree what actual ESG means. Different people would have different definitions as to what ESG means to them, right? Excuse me. And also because there is a difficulty in observing what the outcome is. So unlike analysts' forecast that where the outcome variable is EPS, for example, or bond ratings where outcome variable is default rate, for example, or bankruptcy, whatnot. ESG ratings, there's really no agreed upon outcome measure that is, at least in the academic literature, to current date. So this paper's motivation is essentially, look, there are folks who are essentially saying that ESG ratings are not so much correlated. How do we sort of make sense of it? What do we do from there? And also judge the quality of ESG ratings. So in this paper, we have 3 research questions. First is, do ESG ratings predict future ESG news? So ESG ratings meaning the latest ESG ratings. So you can already see that our panel would be structured at the firm day level, right? And how does this disagreement among raters affect this predictive ability? And second question is, how do consensus ESG rating and the disagreement affect stock reactions around ESG news? And thirdly, is there a predictive power of these ratings on future stock returns? I wanted to sort of, some people say that, oh, of course, ESG ratings should predict future ESG news, but I wanted to stress that the tension is actually there. So, people say that ESG, ratings are, there's a lot of disagreement, right, as I briefly mentioned. And also, the former SEC chairman, Jay Clayton, also said ESG ratings are imprecise and noisy when used together. So for us, it's pretty difficult ex ante to really claim or say that, of course, ESG ratings should predict future ESG news. Summary of the finding is as follows. We use the data from ESG news data from True Value Labs, which is now a FactSet company. And this score ranges from 0 to 100, 0 being the most negative, 100 being the most positive, 50 being neutral, and this sentiment score, news sentiment score, only changes when there's new news. For the ESG ratings, which we use the latest ESG ratings to predict future ESG news, we use ESG data from MSCI, Sustainalytics, and Thomson, which is arguably the most frequently used ESG ratings, right? And we make this range from 0 to 100. And what we find is pretty simple as well. We do find that ESG ratings predict future ESG news. But this disagreement among vendors hinders the incorporation of this ESG news being impounded into price. And we also find that similar to what the prior literature suggested on the disagreement, different raters actually have differential predictive ability on predicting future ESG news. And we exploit this feature and present a pretty simple long-short strategy to predict future stock returns. The reason we do this is as follows. 10 some years ago, when I was a sell-side trader, when I used to call client investors, to pitch ideas and have them to execute with us, their response was, "Hey, bulge bracket banks, add no value to the buy side community because all the EPS forecasts that your analysts put out are so right next to each other." But now, 10 some years later, you talk to an institutional investor, and their main sort of complaint is that, hey, ESG ratings are everywhere. We're confused. It doesn't add any value, and we have to charge higher fees because we need to better understand it. So, this paper is essentially trying to sort of get at this and trying to sort of inform institutional investors as well in their trading decision-making process and also processing ESG information. Academically, we view our contribution is at least threefold. First, there are papers that point out this disagreement, right? And what we do show is that, the ESG ratings can predict future ESG news. And so you can essentially evaluate ESG ratings to a certain extent using ESG news, right, as an outcome variable. And we do feel that this is novel because no one's really attempted to verify ESG ratings. Second stream of papers are papers on market reactions to ESG news. There are a couple of recent papers that looked at, whether market reacts to ESG news or not. And here we bring in the role of ESG ratings and their disagreement into this picture of how market reacts. And lastly, as I sort of talked about, we're essentially trying to propose a quick and dirty method to show how this disagreement feature could be embedded into portfolio decision-making process. So our sample, we have about 9 years of data from 2010 to 2011, 2010 to 2018, roughly working with about 32,000 firm day observations that ranges across different GICS industry. We use industry adjusted return, ESG news and a bunch of ESG ratings, and also average ESG rating construct and its disagreement, and sort of typical control variables for these type of studies. And I wanted to highlight quickly in this correlation table that, yes, indeed, as prior literature found, we do find that there are disagreements among ESG raters, and the correlation is obviously not one, because of course, it's different ESG raters have different scope, weighting scheme, et cetera, and our average ESG rating construct is pretty highly correlated with the 3 ESG ratings individually. So to answer our first question, do ESG ratings predict future ESG news, and how does disagreement play in this game? We do the following. We have ESG, and this panel is structured at the firm day level again. We have ESG news on our Y, or in our dependent variable, And we have our normalized average ESG rating of T-1, which is essentially the latest average ESG rating. We have disagreement and the interaction between the two, plus the control variables, and also industry and date fixed effects. And we examine the first two columns, we examine all news. The next three columns, we examine news that are financially material identified by Sustainability Accounting Standards Board. And what we find is twofold. Excuse me. We find that this latest average ESG rating predicts future ESG news, but when there are disagreements among the three vendors, this predictive ability decreases. Berg et al. 2020 or 2019, I think they just updated their paper, decomposes disagreement to three sources. They identified that different raters' weighting scheme, definition of scope, and how they measure different ESG topics shape disagreement among different data vendors. And we essentially obtain data from them and see whether the drivers, which driver of disagreement influences our phenomenon. And we find, so it's essentially same as the previous table, but we replace high disagreement with the drivers of disagreement itself, weight, scope, and measurement. And we find that this moderating effect of disagreement is driven by the disagreement in how different raters measure ESG issues. Second, we examine how do consensus ESG ratings and disagreement affect stock reactions around ESG news. What we do is the following. We have a simple 2x2, and whatever is expressed in percentage terms is industry adjusted return around the 3 days around the window. And we also separate our news to all news and then news that are financially material. And we examine industry adjusted return of positive and negative ESG news and those with high average ESG rating and low average ESG rating. And we actually find that there is this surprise component. So when your firm has a low average ESG rating, so when all the vendors think that you're a poor ESG performer, and when you experience a positive ESG news, you actually experience a pretty high 42 basis points of industry adjusted return versus only about 7 when you are perceived as a good ESG performer. But for negative news, we don't find such a relationship. So essentially, negative news is always perceived pretty equally bad for both when your firm is a low ESG performer or a high ESG performer, according to these data vendors. And we find that this relationship or this phenomena is much stronger for news that are financially material. We put this into a multivariate format and we essentially confirm the same result. We have industry adjusted return here, positive news indicator, high average ESG rating of T-1 with the interactions. The only thing that I wanted to highlight is the following. So this stocks reaction spread between positive and negative news is roughly about 75 basis points when your firm has a low ESG rating. But then this effect is moderated when, by the consensus ESG rating, as you've seen. And then again, this widens for news that are financially material. Lastly, I wanted to show you that whether there's any predictive power of these ratings on future stock returns. So we examine the differential predictive ability of these three raters. So what we have here is we have ESG news or material ESG news. So this is all ESG news, and we regress these latest ESG ratings from MSCI, Sustainalytics, Thomson separately and also pooled together. And we find that MSCI has the most predictive ability, followed by Sustainalytics and Thomson Reuters. And we form a portfolio using this difference. So we restrict our sample to those firms or firm dates that have high disagreement. And our long portfolio is when our normalized MSCI ESG rating is greater than 0, and then also greater than the average of the other two ratings. So this is mechanical, right? Because when you have a high disagreement sample, when normalized ESG MSCI rating, which is the most predictive, is indicating a buy, the other two will be a sell, right? Short is just the opposite. When normalized MSCI, when MSCI is essentially indicating a sell, the other two will indicate a buy. So the point of this portfolio construction process is that we established that MSCI is the most predictive. Let's follow what MSCI says when there are disagreements, because the other two raters would be contrarian. And we form portfolios from Jan of T+1 to December of T+1. So essentially, and hold it for a year. And we do equal weighted and value weighted approach. And we risk adjust by controlling for market size, book to market, profitability, investment, following the latest Femme French 2016 paper, I believe. This is what happens in a long-short portfolio. So the intercept is the alpha from monthly stock regression. This is calendar time portfolio regression. And what we document is that over the course of 9 years, when you follow that particular strategy, there's roughly about a 4% alpha generated per year that is statistically significant, roughly at the 5% level. So in essence, you can take advantage of the difference. From an institutional investor's perspective, you struggle with the disagreement, and you can potentially use this feature to take advantage of this ESG disagreement. We also try holding the portfolio for 24 months instead of 12 months. And we do find that actually the annualized alpha is much stronger for such a portfolio. When we hold it for 36 months instead of 12 or 24, the intercept generates about 3% alpha, but is not statistically significant. So our interpretation of the result is that it takes roughly about 3 years for the information on ratings to be fully priced in and for the disagreement to be resolved. So this is all I have for today. Overall, we do find that ESG ratings predict future ESG news. And to the best of our knowledge, we are the first one sort of verifying or tying an outcome variable, literally tying an outcome variable to ESG ratings. And we find that this disagreement that is heavily documented in recent academic papers moderates this relationship, and also how ESG news gets pounded into stock prices. But we also find in a quick exercise that potentially this disagreement could be used to predict future stock returns. Thank you very much. That's all I have.
Thanks, Aaron, for the presentation. Actually, very impressive by your paper. So when we're working with ESG, we all work with this data set, like from MSCI, from Standardlytics and Thomson, and also the recent one, which we are covered by the third paper, but we will leave it here. So the data and also some new data is also attracting attentions. And I'm impressed by the conclusion. So here, especially like the ratings, they do predict the future of the news, or the rating, they do predict the future performances regarding the ESG. And also another impressive part is the disagreement to have a story here. So also it's very interesting that we can take advantage of the disagreement between all these rating systems, rating institutions. And actually there is an arbitrage opportunity here. I forgot to mention, thanks for sharing your experiences as a trader. Also, it's very fresh to me now for nowadays in the United States, like for the traders, they are looking at ESG. For traditionally, like the ESG, it for me like sound like fundamental factors. So while we are waiting for the audience questions, I guess there are several questions here. So I will repeat it and the question. So for the question here is, there are many complaints about the low correlation between ESG ratings, but to what extent do they have the same philosophy or measure the same? The Sustainalytics ESG risk ratings are set up different than the MSCI rates. I think that's a good question here.
Yeah, this is an excellent question. And thank you also for your comment, Jing. So maybe I can sort of answer this all together. So this ESG space has took off in the recent, probably I would argue 3 to 5 years in the US, and I think it's catching on to other countries. The issue with the ESG ratings has been, there are many issues, to be really frank, but this started as CSR. This is nothing new. So there are some old traditional academics who point that out, which I think they have a very valid point. But what ESG folks did very cleverly is that they slapped on G and then coined this term ESG, right? So with that, there are multiple issues. What is ESG, right? We ask 10 people in the room what ESG is. They will all have very different answers. And I think this is very closely related to question 3, right? Whoever the audience asked, right? So that's true. MSCI and Sustainalytics have different philosophy. And currently, the state of the world that we're living in is there are movements to embrace that diversity, but also movements to reduce that diversity. Whether that is good or not is an open question, right? So for example, EU taxonomy is trying to harmonize ESG definitions. I think it's a great initiative, but there are also downsides to it. For example, 10 years ago, we didn't have Tesla, right? As a company, huge company, right? These days, market cap of huge. How do we, if we have a regulator defining what ESG is without a good understanding of what ESG is, right? Or good understanding from the capital market on what ESG means, then the issue is, what are you going to do whenever there are new industries, new firms, or new practices, or new natural events, right? So that's something that regulators have to think about. I'm ethnically from Korea. I was in Korea to avoid COVID in the past 6 months. I just came back to the US, and everyone's cousin is claiming that they're an ESG expert. And the government has coined a term called KESG without much knowledge about ESG. And I think these initiatives are all great, but there has to be a lot of thought that are needed in this process of sort of standardizing ESG, what to think of it, to sort of, build on to the different philosophy and measurement system, which is what essentially Berg et al. Points out. That's true. And, when I first sort of got into this ESG space, we probably had like maximum of 10 ESG data vendors, and only 2-3 of them are used. Now there are more than 300 ESG data vendors. A lot of them which tries to tie their ESG ratings to stock returns, for example. So reverse engineering their ratings ex post. So there are, and there are ratings that are more stakeholder focused. There are more ratings that are more shareholder value focused. But I think the key is that each different raters need to have their own philosophy and really sort of stick to that philosophy. And I think that's not what is happening right now. And that is also confusing issuers, firms, because firms now have to cater to a separate set of analysts, right? They cater to Wall Street analysts, but now they have to cater to ESG analysts. And firms are having a very, very tough time to make sense of, what is the best rating? Is it ISS, MSCI? Why is my rating 7 in ISS and 3 in MSCI? What do we do? And I've been telling issuers that you need to have your own story as to what ESG means to you and really talk about your narrative. But it seems like at the moment, because ESG's grown so fast, firms are just trying to essentially please the ESG raters. But when you look at most ESG ratings, if not all, and create a long short portfolio using that as a signal, you don't get any alpha yearly. So now some smart ESG raters like MSCI are essentially saying that, look, we're just compiling data, you selectively use our data. That's their main message these days. And rightly so, right? Because these ESG ratings, even at the very lower down factor level, are a composite of many things, many indicators and many things. And they are just, there's a lot of measurement error and noise into that process. And I think investors, at least really, really sophisticated ones, are now sort of looking into that and trying to distill that information. But I think it's in the very, very baby steps. I mean, we all know from recent FT and Wall Street Journal articles, it's no secret that even big asset managers like BlackRock is essentially greenwashing, right? They're telling folks that they are engaging ESG, but there's whistleblowing cases left and right? And so this is a very interesting space. And I think, I really enjoy a conference like this because academics actually have a lot of expertise that could actually benefit the industry. Because, for example, for accountants like myself, right, we have a lot of, knowledge for the past 100 years that looked at how to sort of set standards and regulate and think about these new issues, right? Same for finance. So I think it's a rich area for, us academics to learn and, share with the industry and push it forward. Long answer to a very short question, sorry.
Yeah, thanks for all this very the information. And while we're waiting for, I think that's very rich for this question. Also waiting for the next question, I would like to share with you some of my thoughts.
Yeah.
As I was like, I'm trying to build also a ESG rating system for Chinese firms.
Mm-hmm.
So all the questions encountered for what you mentioned, why there are so many like ESG raters. Since I agree with you that this issue is start from the CSR. So previously, like we are talking about the corporate, they should take some responsibility other than the stockholders. They should care about stakeholders. Okay, so after that, the financial institution said, okay, we will evaluate you for your social responsibility. So that's why I feel like that's why ESG comes from. So when someone is evaluating something, so it also totally depends on the philosophy and some information you get. So I can imagine that. So it's reasonable that we have so many like rating systems here, and also like we also work with some regulators here in China. Like we are, like the background of the carbon neutrality. So we hope that the firms in China, they take care of the ESG, especially in the E. So from the regulator side, there is one simple question. So what is the ESG mean? So in the regulator side, like you mentioned, EU taxonomy, like we want to do something. First, we want to make a definition of this. So I can share some communication with here in the regulator in China that. So we will begin with that definition. So I guess for the EU taxonomy, I also recently learned that they are sent some, invite some comments to that taxonomy. I think just recently. So for the feedback, there are so many comments on their current taxonomy. So I guess it's a big challenge to make a like consistent definition, which also help to communicate across the markets. Like from the EU market, the Chinese market, and the US market. We want to talk about the same thing when we are trying to make the world more sustainable. So I guess this is the debate. I totally agree with you that the debate, like we want to push to move to a more sustainable world, but the ideas, the perspectives, and the information we have all are limited. So I guess it will exist for a long time that we are still in this kind of like a stage that But I still like the conclusion from paper that the disagreement to bring opportunities. So we have different philosophy, different measurement, and as you share in your paper, like for the scope and for the second one and the third one, the measurement. So it's the measurement that makes the disagreement. So it also bring the new question, like how you measure your firm. So that also brings the professional and also probably business opportunities.
Right, and I think I have 5 more minutes, right? Is it okay if I just? Yes. So one other thing that I really think is a crucial issue in ESG. So I interact a lot with the regulators and issuers and institutional investors as well in the US and the Korea side. And everyone is like, well, shouldn't ESG be charity? And I think it speaks to different philosophies towards ESG. And so, for example, you have CEOs in Korea, like delivering food, like lunch boxes to people, and they call it an ESG, right? And if you think about it, every ESG activity that a firm engages in, regardless of their philosophy, whether it is stakeholder focus or shareholder focus, is firm level investments, right? Whether they reduce greenhouse gas or disclose more, they're all using firm resources, there's no doubt. The issue is twofold. If you're using firm resources, if there's input, if we think about it in a very simple corporate finance 101 type of framework, there has to be output.
Yep.
And I think but there are a group of folks who think that, oh, ESG should not be related to any value, but I think that's a little bit of a stretch, right? So it has to be related to value somehow, but I think there's going to be this cross-sectional variation across different firms because of ratings disagreement or communication of ESG or measuring ESG or firm philosophy. So I think that's sort of been my research agenda to how to sort of tie that at the cross-section. But it's been, I think, folks in the CSR camp has been really faced a lot of difficulties. It has been a really uphill battle fighting it, right? Because when you talk to a traditional sort of Milton Friedman type of camp, they were like, well, ESG is just destroying value, it's fluff and la, and there was just no answer to fight back. But then I think now, because more and more empiricists in finance, accounting, strategy, econ are getting into this sort of granular measurement and tying it to value. I mean, I don't think tying it solely to value is a good idea because there are obviously other stakeholders, but if you don't have a company, how can you feed the stakeholders, right? Essentially, right? That's sort of the issue, I think, with the ESG space. So it's a rich space for sure.
Rich space. And also so for the corporate finance that there is a cost. Like you say, the cost and inputs for the resources. Yeah. So we're looking forward for payback or outputs. Probably not in this year, probably in 10 years, but sure. It's just a research area that worth to explore whether ESG is a cost or a benefit and in how long. Yeah.
That's right. Thank you.
Thank you. And also from the audience, thanks for your answer. Fully agree with you. From that audience.
Thank you.
So I guess we are talking so long, so no more questions here. So let's move to the third paper. It will be brought by Chen from University of Exeter. Sorry, I can't pronounce that one. Forgive me. The paper title would be "Do Active Fund Managers Exploit Material ESG Information?" So it's your turn, Chen.
Thank you, Jing. Thank you for the introduction. And also thank you for having this paper, giving me this opportunity to present this paper. So my name is Chen. I'm a lecturer in finance at the University of Exeter. And this paper is co-authored with my colleagues Linquan, Chen, Alok, Kumar, and Woon, Leung. Sorry for sharing the same sentence over and over again. So I think the motivation for this paper, or maybe for all researchers in sustainable investing will be like because of the growing importance of ESG. So we have seen this in Aaron's presentation, right? So the PRI has attracted over 3,000 signatories with 120 trillions in AUM by 2020. But if we look at the universe of asset managers or funds with explicit sustainable mandates, it is still a relatively small universe. So if we look at the US market, so there are only 392 open-ended funds and ETFs with explicit ESG mandate available to investors by the end of 2020. So if we aggregate their AUM, that is only approximately 0.24 trillion. So comparing this number to the whole universe claiming they care about ESG, this is not much. That simply means it remains unclear how and to what extent a typical asset manager incorporate ESG information into portfolio decisions. Because ESG, if we consider the two sides, on the one side, we want to care, ideally, if we can, we want to care returns. On the other hand, we also care about social benefits, right? But it looks like, even though the majority of asset managers claim that they care about ESG in their investment decisions, their clients may not be so interested because most of the clients, they are still like mean variance investors. They want to maximize their returns given a certain level of risk, right? So to answer this question, how do the majority of funds or asset managers consider ESG information into investment decisions? We need to first look at what are the available options for these asset managers. So according to the reporting framework of the PRI or the CFA Institute, sustainable investing strategies can be broadly classified into 4 categories. I'm sure you should all be very familiar with these. So the first one, or the most traditional one, would be screening. So we can exclude certain sectors, and then we can only include good firms or good sectors. And there are also engagements and also or thematic. So let me just get this laser point here. But thematic is relatively a niche market. For example, we only look at companies that are focusing on green renewable energy, something like that. But because the majority of funds, maybe they are still focusing more on mean variance efficiency, that simply implies some of these sustainable investing strategies are not quite applicable to their investment objectives. For example, screening and thematic strategies, these will if you consider these, you will have to exclude certain firms or certain industries, and that could hurt your diversification. And we do have papers showing that. So if you only focus on certain industries, you will have higher idiosyncratic risk at the fund returns. And also, engagement is a very popular sustainable strategy, but the problem with this is that firms or institutional investors, when they engage in these activities, the success rate is kind of very low. So therefore, the impact is still very limited at this stage. So therefore, we look at the last or maybe the most comprehensive sustainable investing strategy called ESG integration. According to the definition of PRI, this is defined as the explicit and systematic inclusion of ESG issues in investment analysis and investment decisions. That simply means if you consider ESG integration, it doesn't really require you to change your existing investment philosophy. You just further include material ESG issues to broaden your information set. And we conjecture that because this does not really affect the mean variance efficiency of investment firms, therefore it is likely to be one of the most popular choice for a typical fund manager. And supporting this view, the PRI report shows that ESG integration is a dominant strategy pursued by US signatories, with 61% of AUM uses it as the standalone strategy for investing in listed equity. So we have, motivated by this, we have 3 research questions in this paper. First, we look at whether and to what extent do a typical fund manager incorporate ESG integration into investment decisions. And second, a natural follow-on question will be, what are the motivations for pursuing such sustainable investing strategy if they do consider this? And then the last question will be, which fund managers will have stronger incentives to consider this sustainable investing strategy? But to answer these questions, due to data limitations, it is actually quite challenging. So for example, ESG integration will require asset managers to review and collect information from publicly available resources periodically. So according to PRI, so most ESG integration techniques such as periodic review and regular rating updates, they are conducted at quarterly or even higher frequency. That means using the existing widely used ESG data like KLD, Asset4, these are annual frequency data. So it is unlikely that fund managers will adjust their quarterly portfolio holding using a very lagged data and with low frequency. So we need to have a good proxy for timely ESG information data. And a second challenge, for example, if we want to investigate the motivations behind asset managers' ESG integration strategy, one important aspect will be to examine whether they have the ability to identify material ESG information. Our previous presenter, Aaron, he has a very influential paper published in TAR showing that ESG matters to firm value only if this ESG performance category is material to the firm value. Otherwise, it doesn't really matter. It doesn't really affect firm performance. But the existing ESG data, we don't have like a clear map to ESG materiality, because obviously ESG materiality will vary across industries and sectors. So to address these questions, we use the same data in the previous paper. We use the data from True Value Labs. So it collects firm-specific ESG information from various sources such as mass media, industry publication, and governmental reports. And these are also the same sources that are pointed out by the PRI that asset managers should collect information for their ESG integration decision-making. So, and more importantly, this data integrates the SASB materiality framework. That means we are able to link, to map the performance in each ESG categories to the firm, showing that which category is material and which category is not. And then we are able to directly examine fund managers' ability to test, to infer ESG materiality. So our key conjecture is that the pulse score constructed by True Value Labs can effectively summarizes fund managers' main information sources for ESG integration decision making. So here is a quick example of our data. So for example, we see the pulse score for Apple during June to December 2017. We can see that if there is a positive ESG event by the firm, for example, in here, when the Trump administration quit the Paris Agreement, Apple issued a US $1 billion green bond. And then obviously this is a pro ESG activity. So we do see like a positive, an increase in the pulse score. And in comparison, at the end of the year, we see like Apple had like a battery scandal of their iPhones. So they intentionally slow down their old iPhones and then force investors to buy new ones. So, and then you see a drop in the pulse score. And then all these events, we can trace back to the to the article that are related to the event that drives the changes. And also we can see what ESG categories are these article related. So this will be our main measure for the information source of ESG integration. And obviously, because we look at asset managers, so our main focus will be all actively managed US equity fund. So we collect mutual fund data from the standard mutual fund data sets. And then what we do is we merge the CRISP with Morningstar mutual fund data sets to ensure that these two data sets have consistent total net assets and returns. And then to control for conventional ESG ratings, we use these standardized ESG ratings from KLD, Sustainalytics, and Refinitiv, formerly known as DSF4. And we also use these standardized data from CRISP, CompuStat, and IBES. So our final sample, we have basically a fund firm quarter panel. So we look at all actively managed US equity funds. We start our sample from 2007 because the TVL data is available from 2007. And then overall, we have about 1.7 million fund firm quarter observations, and that covers about 1,800 funds and 1,500 stocks. And here is a breakdown of our sample by the Pharma French 12 industries. And you can see that we have a reasonable coverage of all these firms. Okay, so to answer our first question, do fund managers integrate ESG integration strategy in their portfolio decisions? So this is our baseline regression model. So we focus on our left-hand side is the market value of firm J owned by Fund I in quarter T divided by the total net assets of Fund I. And then our main explanatory variable will be the poll score. So if fund managers consider ESG integration, then we should expect the portfolio weights in the mutual fund should be correlated with this poll score. And then we include a battery of fund and firm controls. And then we also control for fund, firm, and year quarter fixed effects. So if they do implement ESG integration, we will expect beta 1 to be significantly positive. And here's what we find. And indeed, we find on average, a typical fund manager, they do consider ESG integration. So we modify our main specification by using different fixed effects and different controls. We always get a highly significant positive correlation for the polls. And then in terms of economic significance, so a 1 standard deviation increase in the poll score is associated with around 66,000 to 96,000 extra US dollar investment in a typical fund firm pair in the next quarter. And next, we try to control for other variables that could potentially explain our results. For example, we control for this low frequency ESG ratings, and we find that they do not actually explain the portfolio holdings, the quarterly holdings of mutual fund managers. And in columns 4 to 6, we change our dependent variable because our existing dependent variable could be affected by share price, right? Could be artificially inflated by share price. So in our alternative dependent variable, we consider the total number of shares held by a firm divided by the total outstanding shares of this firm. But we find similar results. And then in the last 4 columns, we control for investor sentiment because obviously these ESG events, if they appear in news, they are likely to generate investor sentiment. And after controlling for stock overnight returns or the negative sentiment generated by financial reports of the company, we still find a positive relation between the poll score and the next quarter mutual fund holding. So therefore, these results rules out this alternative explanation. So they are all significant. And lastly, we look at whether these ESG signals are adding additional information to the conventional fundamental signals. So for example, short sellers and sell-side analysts, their their reports are known to affect fund managers' portfolio decisions. So we consider these as the processed, the fundamental information. And we also include a bunch of unprocessed information, such as Tobin's Q, return on assets in these specifications. And we, after controlling for these conventional fundamental signals, we still find that these ESG signals, ESG information is adding additional power to explain mutual fund holdings. That means this ESG information, they are not simply repackaging conventional signals. And that answers our first research question. And then in the second research question, we look at why do fund managers adopt ESG integration strategies? So motivated by the existing literature, we focus on two non-mutually exclusive explanations. The first one, we look at investment skills. So past literature shows that fund managers, they may have investment skill to generate better return or to lower the risk, namely to increase the Sharpe ratio. And also, fund managers could cater to investor demand. For example, Barber and Odin shows that salient events in news will attract investor demand. And Solomon et al. Shows that mutual fund managers actively cater to such demand by holding stocks with good news, and that can attract investment flows. And a recent JF paper by Hasmark and Sussman shows that investors actually favor ESG. So funds with good Morningstar sustainability ratings actually attract higher flows without having better performance. So therefore, in the second part, we investigate these two hypotheses. So to test the first hypothesis, we look at whether fund managers, the skill hypothesis, we first look at whether managers have skill to infer ESG materiality. And this, our data, the TVL data allows us to do this. And basically we map the materiality of ESG categories to each firm using the mapping provided by TVL. And then we split our all category poll score into the material and immaterial scores. And then we include them in our baseline specification. And then we find that fund managers, they actually have skill to infer ESG materiality. So for example, if we include these variables separately, we can see that fund managers only respond to material ESG information. And if we include them together, we find similar results. So immaterial ESG information are not relevant or does not affect mutual fund holdings. And we find similar results if we use an alternative dependent variable. So this shows that managers, they actually have the skill to identify material ESG issues that are relevant for their for firm value, therefore to potentially increase the performance of the mutual fund. And in the next set of tests, we look at whether these propensity to trade on ESG information affect future fund return. And we do find that we follow the method used by Fang et al., the 2014 IFS paper, to estimate the propensity of for fund managers to engage in ESG integration. And we do find that managers with the highest propensity to implement ESG integration, they earn higher risk-adjusted returns. And the results looks very similar if we use a Farmer-Macbeth regression model. And then for the second hypothesis, we look at fund flows. So we test whether managers conduct integration to attract investor flows. So to test this, we aggregate the poll score to the portfolio level using by evaluating stock level poll scores. And we see that whether investor flows are responsive to the poll score at the fund level. And we do find supporting results. And we also, in terms of economic magnitude, so a 1 standard deviation in mutual funds poll score is associated with 3.7 million higher inflow in the next quarter. And we find similar results if we use only the top 10 holdings of each mutual fund to construct the portfolio level pulse score. And then the economic magnitude is very similar. And for the last part of the paper, we look at whether heterogeneity in fund attributes affect managers' incentives for ESG integration. So motivated by the previous literature, we look at several fund attributes. So the past literature shows that Democrats, they care more about ESG. And funds with more of a democratic leaning, they care more about ESG, and their investors could also be more sensitive to ESG. And secondly, socially responsible funds, they could have more experience in sustainable investing, so they may respond more or engage more in ESG integration. And lastly, if ESG integration has a catering propensity, and then probably funds that are more effective in catering could respond more to ESG information. So for example, salient funds, I mean funds with the high 12B1 fees, or funds that are less affected by name-induced discrimination, they may have stronger incentives to do that. And we do find supporting results. So we use the location of a mutual fund to define its political orientation. We do see that funds located in democratic states, they respond more to ESG information. And if we look at the mutual fund rating, the ESG rating of mutual funds, we also find that SR funds, they respond more. And in terms of mutual fund salience, we do find that salient funds, they respond more to ESG information, and they have stronger propensity to implement ESG integration. And then lastly, we look at whether fund manager's name will affect their propensity to implement ESG integration. So we get the data directly from the Kumar 2015 IFS paper. So basically what they do is like they collect manager names of single manager managed fund, and then they do an online survey asking people, do you consider this name as foreign or non-foreign? And they do find that investors tend to favor fund managers with a local or American sounding name. So they will reward them more cash flows if they perform good, perform well, and punish them less when they perform poorly. Therefore, we conjecture that if managers they have American sounding names, then probably they have like a stronger propensity to conduct ESG integration to attract flows. And we do find supporting results as well. So in conclusion, in this paper, we look at whether asset managers actively implement ESG integration. And then our finding is yes. And then when looking at the motivations for such activity, we find that investment skill and flow catering jointly motivate managers to pursue ESG integration. And we also, when we look at fund attributes, we find that managers with more experience in sustainable investing and with ESG sensitive clients, they may respond more strongly to ESG information. And also fund managers who benefit more from flow catering also have a stronger propensity to respond or to make use of ESG information. That is my presentation. Thank you very much.
Thanks, Young, to bring us this story. Like fund managers, they are implementing ESG integration, and also why they're doing so, like they are catering to the need of the market, and also because of they have such skills, and also they can also interesting to learn that the American song name something they also be a factor here. So thanks for that very well organized and very comprehensive analysis. Really enjoy this. So while we're still waiting for audience questions, actually I have a quick question for here. I do think it's interesting to learn that the manager they do integrate ESG information, and they do incorporate material ESG information. I remember you mentioned that it's from the SASB. So could you please introduce more regarding how you to make it to separate the material and the with immaterial information here from SASB?
Right. So for each news article, then TVL will classify these events according to the SASB definition of ESG categories. So there are 26 overall categories defined by the SASB. So each news article, you will know that which categories this is related to. And then the SASB also classify each company into different sustainable industries. So for certain industries, certain ESG category will be financially material, and there's an ESG materiality map. So this data, the TVL data, provides the article volume and the corresponding ESG category for each ESG events. So what we do is we simply calculate volume-weighted pulse score using only the material category and the immaterial category. So the two scores are constructed using mutually exclusive ESG events. And then, yeah.
So sounds like the two dimension regarding the material or from the SASB is like from the industry or sector, probably they are sustainable or not sustainable.
Yes, so it's
firm, and then for each firm, like SASB will label, like this part is material and this part is not material. So they make a very clear definition on the material for the firm and for the industry.
Yeah, exactly.
I see. So yeah, we'll still have a few minutes here, and just bring you another question. It's a quick question regarding the sample. You mentioned that the observation is from 2007 to 2017. And it's covering around 1870 unique funds and also 1519 unique stocks. So I mean, like when I first looked at the stocks number is, I think it's far less than my expectation. So around 1,500 stocks, unique stocks for this like 1,800 of funds.
Yeah. So these are limited by the coverage of the TVL data. So when they initially started, yeah, they didn't cover that many firms. So we want to keep as many firms as possible, but that is the largest we can get. And also this relatively small number of funds is because we do the cleaning process. So we need to merge CRISP mutual fund data set with Morningstar. And this merging process is like very strict. So that means if the two data sets are reporting different total net assets or reporting different returns, we have to drop them to ensure consistency.
Yeah, so that's also loss of sample.
Yeah.
Okay, so, and for the fund, you mean the active fund manager, so do you differentiate from the passive and active fund managers here? Or these are all the active fund managers?
So these are all active fund managers.
All active
because ESG integration for passive funds, the strategy is slightly different. So for example, they may need to choose like a better benchmark to follow using the new ESG information, but they cannot like really vote with their feet. So to actively adjust portfolio holdings, these are only done by the active funds.
So we just focus on the active fund and also with the data available. So I think still very, very impressive, especially when we combine yours with the first one with allowance paper. So all with the institutional investors and how they looking at the ESG ratings and also how they incorporate this and how the market reacts to the institutional investors, how they react on the ESG. So I do think for these two papers really give us a more deeper or more comprehensive understanding regarding to the institutional investors. So thank you again. So I think there's no more questions from the audience.
Can I ask a question?
Sure.
Yeah, sure.
Hi, very nice presentation. I really enjoy it. I have a question because you do not mention a lot about the pulse, how you define the pulse. I'm just curious about whether there's asymmetry between the negative information and the positive information, because Aaron just showed that the return actually react differently towards very positive information or very negative information.
We do have some tests by splitting news into positive and negative, and we find consistent results with Aaron's results. So fund managers mainly respond to positive news, and they tend to ignore negative news.
That's interesting.
Yeah.
Good to learn.
But actually, according to Aaron's paper, the return, the negative return actually reacts stronger towards negative information. Because for the positive information, those with high ESG stocks actually do not react very, very strongly, because people just assume that they should perform good. In terms of negative information, all the stock returns actually drops a lot.
I think the difference between this paper and Aaron's paper is like Aaron is like doing some double sorting, right? So he's looking at ESG rating in addition to, and then compare within certain ESG rating, positive news and negative news, right? So we are what we look at is like we look at unconditionally. So we look at just purely like all stocks. Yeah.
Okay, got it. Thank you.
Thank you.
And thank you. So it's close to the end of our session. And thanks again for all your presentation, and thanks again for all the audience participation. Hope all you have a good time here. Thank you.